the July job report, Federal Reserve stance, and international market turbulence. The economic headlines have been a whirlwind this week, with a mix of job reports, Federal Reserve actions, and international market fluctuations sparking concerns across all sectors. The current economic climate is shaping up to be a complex and potentially volatile period that could have significant implications for the consumer packaged goods and retail industries, as well as consumer spending habits. The reality is that the U.S. economy is currently growing, though at a moderate pace. In the second quarter of 2024, the real GDP increased at an annual rate of 2.8%, according to the Bureau of Economic Analysis. This followed a 1.4% growth in the first quarter. As we dive into the economic landscape of July 2024, several salient developments have emerged that are shaping the future of our economy, impacting the consumer packaged goods and retail sectors significantly. The latest job report from the U.S. Bureau of Labor Statistics showed that non-farm payrolls increased by just 120,000 in July, significant below the market expectations of 200,000. The unemployment rate rose to its highest level since 2021, 4.3%, according to the U.S. Labor Department. This tepid increase in wages could signal limitations on consumer spending power, a pivotal factor for the CPG and retail industries that rely heavily on sustained consumer demand. In response to the data, on Monday of this week, Japan's benchmark Nikkei 225 dropped by over 12%, the biggest drop for the index since 1987. Other markets across Asia were hit by the U.S. jobs data. South Korea's index dropped by more than 9%, while Taiwan's exchange dropped by 8.4%. Markets in Singapore, Indonesia, and Thailand also all fell by around 2 to 3%. When the UK markets opened on Monday, there was a similar impact. The FTSE 100 suffered its biggest drop in more than a year, with the index opening down 159.05 points. Now, the Fed may have acted too late on rate cuts, but it has a ton of leverage, including multiple big rate cuts to get its inflation jobs back into equilibrium. Remember, rates are at a 23-year high, and the Fed was not hesitant to take rates from zero to the current level in record time to fight inflation. The Federal Reserve's decision to maintain interest rates at the current levels has been met with both relief and with concern. On one hand, maintaining rates can be seen as a move to sustain economic growth and avoid abrupt market shocks. On the other hand, the lack of a rate cut signals that the Fed's caution in response to potential inflationary pressures and macroeconomic uncertainties. The decision not to cut rates has left some anxious about the availability of cheap credit, which can affect everything from consumer loans to business investments. For retailers and CPG brands, this means continued higher borrowing costs and a potential curtailment of investment in growth initiatives, advertising, and innovation at a time when they need it the most to maximize every opportunity in a very competitive market. In face of these economic headwinds, consumer spending, a critical driver of the U.S. economy, could become more restrained. As wage growth softens and borrowing costs rise, consumers may choose to pull back on discretionary purchases, opting instead for just essential goods. This shift has historically pressured CPG and retail sectors, as brands may need to adjust their strategies to accommodate these changing spending patterns. The July job report, the Federal Reserve's decision to hold interest rates steady, and the turmoil that's been seen in the international markets paint a picture of cautious optimism intertwined with uncertainty. For the CPG and retail industries, adapting to these dynamics is crucial, especially as they battle a new higher minimum wage and continued labor shortages. Companies looking to thrive in the upcoming months must navigate shifting consumer behaviors, harness data-driven insights to meet demand, and focus on maintaining operational efficiencies to weather potential economic storms ahead. The emphasis on agility and responsiveness in strategy will be the key for success.